Hi friends, good day. Today, let us try to understand about free cash flow, advantages of free cash flow, disadvantages of free cash flow through this video. According to Robert J. Schiller, the ability to focus attention on important things is a defining characteristic of intelligence. Before we go in,
please subscribe for more videos. Click the bell icon for updates.
what is free cash flow? Free cash flow is the amount of cash a business has left over after it has paid for everything it needs to continue operating, which includes building, equipment, payroll, taxes, and inventory. In other words, it can be referred to as the cash left over after a company pays for its operating expense and capital expenditure, also known as Capex. The free cash flow tells a company how much cash it is generating after paying all the cost. Through this, the business owners know how much money they have to spend at their discretion. This is a key indicator of company's financial health and desirability to the investor. Unlike earnings or net income, free cash flow is a measure of profitability that excludes the non-cash expenses that are present in the income statement and includes spending on equipment and assets as well as changes in working capital from the balance sheet. It is also a way of looking at a business cash flow to see what is available for distribution among all the security holders of a corporate entity. The free cash flow may be of use to equity holders, debt holders, preferred stockholders, and convertible security holders when they want to see how much cash can be extracted from the company without causing any issues to its operations. FCF is equal to CFO minus Capex, where FCF is equal to free cash flow, CFO is equal to cash flow from operations, Capex, which is capital expenditure including maintenance Capex, and capital work in progress. The cash from operating activities is the amount of cash generated by the business operations of a company. But not all of the cash from the operating activities can be taken out of the business because some of it is required to keep the company operational. These expenses are the capital expenditure. For example, let us say a company XYZ cash flow statement reports Rs 15 lakhs under its cash flow from operating activities and Rs 5 lakh of capital expenditures for the year. So the free cash flow will be 15 lakh minus 5 lakh, which is equal to 10 lakh. The company's cash flow heavily relies on the state of company's cash from operations, which is significantly influenced by the company's net income. So if the company has recorded a significant amount of non-operating earnings or expenses that are not directly related to the company's core business, the analyst or the investor should carefully exclude these from the free cash flow calculation in order to get a better picture of the company's cash generating capacity. An example of non-operating earnings or expenses is a one-time gain on the sale of an asset. What is a good free cash flow? The presence of the free cash flow itself indicates that the company has a cash, and this cash can be used by the company as it sees fit. The cash is generally used for expanding, developing new products, buy back stock, pay dividends, or reduce its debt. High or raising free cash is a sign of a good company that is thriving in its current environment. It suggests that the company is generating excess cash that can be reinvested in the business. It also means that the company has a reasonable amount of funds for its future growth. If a company does not have positive free cash flow, it indicates that the company is spending beyond its means. Such a company raises funds from its additional sources like debt or equity dilution to meet its requirements. These funds raised from the debt increases the profitability as it increases the expenses like interest and also increases the bankruptcy risk, and if the funds are raised from equity, it leads to the dilution of the stake of the existing shareholders. Moreover, if two companies have the same free cash flow, it doesn't mean that they have a similar future prospect. Few industries may have a higher capital expenditure compared to other industries. Further, if the capital expenditure is high, we need to investigate whether the reason for the high capital expenditure is due to expenses in growth or expenditure. We need to read the quarterly or annual reports of the companies carefully in order to learn the right reasons for the increase in the Capex. Since FCF has a direct impact on the worth of a company, investors often hunt for the companies that have high or improving cash flow, but undervalued share prices. The disparity often means that share prices will soon increase. Free cash flow measures the company's ability to generate cash, which is a fundamental basis for stock pricing. This is the reason why some people value free cash flow more than other financial measures, including earnings per share. Advantages of FCF. It allows the investors to have a close, intrinsic stock value, which helps the investors in making a better decision. FCF is a trustworthy measurement that eliminates the guesswork because the reported earnings can be evaluated with more accuracy. It helps the investors in understanding the real value of the company and if the stock price of the company is over or undervalued by the market right now. Disadvantages of FCF. Unless a certain percentage of risk is built into the equation, free cash flow is not a one solution for all. FCF only works when the company is operating with 100% transparency. If there are questions regarding the cost trends, sales practices, and other information which affect the free cash flow, then there is too much uncertainty to use this as a tool for the investor. Although FCF is a good measurement, the investor needs to make a few assumptions on what will happen in the future and the accuracy of these projections if the measurement is correct or wrong. Well, thank you so much for watching. Please like this video and do share.